JJ, the CPA here. Hope you're doing well. So where's the sizzle when we're talking about tax planning? Tax credits is where it's at, but the way you save taxes, no matter what, in business is it's spending money. So if you're going to spend money, you want to spend money on things that you need, that you would benefit from. And when we hit year end, any year end, you start thinking, well, how's this year look compared to next year? Do I want extra deductions this year? Are there things that you need next year that cash basis you could buy this year to then get a deduction? But let me tell you where it's at, so to speak, and it's tax credits. See, a tax deduction, we all know this, but just in case, is going to save you because a tax deduction reduces down your income dollar for dollar, but it doesn't reduce down your tax by the dollar amount of that deduction. So a tax credit, it is going to reduce down your tax dollar for dollar. So if you had a $10,000 tax deduction, and let's just say that your blended tax rate, your average tax rate in this given year, let's go real simple, 30%. So that $10,000 deduction is going to reduce down your income 10 grand, and then it's going to save you $3,000 in tax. Now, when we're talking about a tax credit, if you had a $10,000 tax credit, then that $10,000 is going to save you $10,000 in tax. So if there are things that you can do that yields a tax credit, it seems pretty obvious, right? It's going to be bigger bang for your buck. So where do we look for tax credits? Well, some of these are right in front of us. Maybe you don't think that they're big or that you don't qualify, but you've got to have your eye on the ball to ensure. And for small business owners, you can't wait for your tax advisor to call you because a number of these things would be in special circumstances. So your tax advisor is only as good as you allow them to be, meaning the more information they have, the better and more effective they will be for you. Now, I've got a couple of seminars. I'm going to pull up some slides here and just show you on some tax credits here. So here is my seminar, and you can get access to this. And I've got a couple of live presentations for CPE. And once I've done a live version, you'll be able to buy access to rewatch it. So got quite a bit of stuff in here, really do kind of a deep dive. What do we got here? 320 slides. But when we're talking tax credits, ones that are like right in front of you, what we want to take a look at here is things related to employment. So work opportunity tax credit. Now, many would think, well, that's not going to apply to me. But if you're doing new hires and you pay attention to who you're hiring, you've got to identify them within the first 28 days. But qualified veterans, an ex-felon, a summer youth employee, qualified long-term unemployment. So I've got some more detailed videos on this. I'll give you a link to in the body of this. Empowerment zone. Figure out if you are in an empowerment zone. How do you figure it out? Well, I've got a link in the video where I talk about this. You find out, is your business in an empowerment zone? Yahtzee, because if you have any employees in there, then the first $15,000 in wages to that employee, you're going to get a 20% credit. What is a credit, remember? It saves you tax dollar for dollar. New markets tax credit. If you're in an eligible community doing some development, credit's worth 39%. The shop health credit here for small businesses that are getting health insurance on the shop program, 50% on your premiums. Now, with this, what you have to take a look at is whether or not you're a small employer, because there are some requirements on this. Many small businesses are missing out on this, the family leave tax credit. So many small businesses, very generous. We have employees, we treat them like family. And when they are out and have run out of PTO, paid time off, or sick or vacation, well, we may still pay them. And if they are out due to Family Medical Leave Act reasons, then you're going to get a credit for that. You pay them 100% of what they normally make, and that's a $25 tax credit. R&D credits, many dismiss this, including myself probably. Now, fortunately, I work with kind of the same type of clients in the service industry, but many are missing the boat here. We know that with R&D, we think, oh, well, my business is not You don't own any microscopes. You're not doing any kind of scientific research. But the thing I want you to note here, I cover this. We do have to do some amortization, but the amortization rules did not change the fact that you can still get an R&D credit, and that's up to $500,000. And on the credit for early years of a business, if they're not yet profitable, if they're less than 5 million in gross receipts, then in the first 5 years, then they can get a credit against their employment taxes. And it is something that would definitely help. But when we are looking at this, we're talking about developing processes, patents, formulas, techniques, prototypes, or software, improving, redesigning. If you have designers, engineers, you're creating something new. Now, we could get real goofy real quick, and you know me well enough that we don't get goofy when we're talking about tax planning, but you do have to look at what the definition is with the law. So if you're creating something new in your business, a new system, and there's a need for it, and you've had to test it out, and there's some significant expense to it, you very well may find that you would qualify for a credit. So I've got a number of slides related to this that I cover. And then we've all talked about the employee retention tax credit. That's something that's back in 2020, in 21. But I am going to pop down here to some green tax credits that I dare say are fairly sexy. And on these green tax credits, let's see, wow, I cover a lot of stuff here. Where's those green? Here we go, green tax credits. So there's a ton of new credits that have come out. Now, a lot of these are kind of obscure, but again, I have videos related to this. I'll give you a link to that playlist. But if you're getting heavy duty vehicles, right, there's a $40,000 per vehicle tax credit if it's a green vehicle, and there's no limit to that, and it continues to carry over. Now, many businesses, if you're getting an electric vehicle, whether it's big or small, well, you're buying an alternative fuel vehicle refueling property. And that's basically a unit that you then can plug into and recharge that vehicle. Now, one of the things I want you to note is that starting in 23, this equipment, if you will, can only be in non-urban or low-income areas, non-urban meaning not in the city. But if you think about it, a lot of businesses, as they're expanding and maybe now need more space to park corporate vehicles such as the vans or the trucks, et cetera, well, they probably need to put that on an expansion of land. Well, not a bad thing, because here, doing it outside the city, well, that would give you then that qualifying credit. Now, there's a number of things related to these new green credits, especially with this one, but it does include basically the cost to get it installed and the battery, all the components related to that. Also, there is this solar tax credit. Now, this could be one of the sexiest credits I've ever seen in my entire career, 31 years. Now, we all think about solar panels going on the house. What we're talking about here, though, is we're talking about a solar credit for businesses. And there's two types. You get an either or, the investment tax credit, ITC, or the production tax credit. So the investment tax credit is all upfront. Production tax credit is then over time. So if you have your equipment in a sunny area, it's going to produce a lot of energy. You get a credit as it produces. Well, then maybe overall it could be a bigger credit over time. But check this out. So it's a 30% tax credit, but it doesn't stop there. When we're talking about 30%, it's 30% of the cost. And when we now are looking at the location of this, so I'm going to skip ahead a few, but if it has domestic content, meaning basically it's made from structural steel and iron parts in the US, you get another 10%. So that makes the credit 40%. If it's in an energy community, you get another bonus amount of 10% on top of that. If it's in a low income area, you get another bonus credit amount in addition to that. So another 10%. So this thing really adds up. So if you're a tax exempt organization, you're considered direct pay. That means that you get the money from the IRS. Here's the deal, and I'm going to give you a link to the next video that your mind's going to cook on it. And you're going to go, man, I'm so glad I got to hear. But you also then can get this credit and you can transfer it. And check it out. When you sell these credits, these specific credits, it's not taxable income. You heard that correctly. So check out that next video. I'll give you a link to it at the end. And also, when we're now talking about these credits, here's what I want you to know, is that you can carry back that credit 3 years, and then it does carry forward 22 years. Now, it's non-refundable. All that means is that it's going to zero out your tax, but then after that, it's just going to go ahead and carry over year after year after that. So you do have to keep it in play for at least 6 years. But one of the things I want you to know, let me get back to the slide here. Check it out on the depreciation. This credit doesn't stop by just there being this huge, massive amount to reduce down your taxes. It is a depreciable life over 5 years, meaning it's a shorter life. It is eligible for bonus as well as Section 179, meaning you can get immediate deduction for it on the depreciation. Now, any credit, you reduce down that cost basis by the amount of credit to determine your depreciable basis. So you're making $1 million investment, and if the credit's 30%, well, that's a $300,000 tax credit. Boom. Then your depreciable basis normally would be 1 million minus a $300,000 credit, or 700,000. Check this out. With the investment tax credit, you only reduce down your depreciable basis by 50% of the credit. So in my example, $1 million investment that yields a $300,000 credit, you'll only reduce down the depreciable basis by 150,000. That means that there would be 850,000 left to depreciate. Bonus depreciation all year one. Now, we got to remember passive activity. Now, if we are talking about the production tax credit, well, it doesn't reduce down the basis at all, and you are able to write that off. Now, we got energy efficient commercial deductions. This is really related to deductions, making it efficient. And what it does is allows you to just tax deduct portions of that expansion. And there's credit for builders, $5,000 per home for those that are putting together energy. So in the next video, I'm going to talk about this tax credit amount, and it's pretty sexy. So with that, thanks for tuning in. One of the things that you might find, especially as we move forward, I'm finding myself limited in time. And so you may have noticed I didn't have a nice little sexy opening with my catchy music. And I'm not going to have one at the end here. So with that, I'm going to go ahead and say, thanks for tuning in. I'd love it if you'd subscribe. And then don't you ever forget, you've never met a CPA quite like me. And go take my seminars or buy access to it. So I'm going to keep talking for a few minutes so that you have time to see what I'm linking here for you to a seminar. Subscribe to my channel. Check out the next video on tax credits, or the playlist on the tax credits that we were just talking about. And so with that, I am out of here. All right. I appreciate you so much.